Hello, I'm David Cassidy with the market summary for the week ending the 27th of March. Global equity markets rallied strongly on the week on optimism that America's $2 trillion fiscal stimulus package will mitigate the economic impact of the coronavirus outbreak. For example, in the US, the Dow Jones rose nearly 13%, while the broader S&P 500 index ended the week just over 10% higher after recording its strongest three-day advance since the 1930s, although they remain well below levels since the last valuation date of the 5th of January. The S&P 500 is down 21.43%, while in the UK, the FTSE 100 is down 27.71% over that period. However, that is not to say we only saw global markets rise. In fact, we saw big swings in both directions almost every day this week, given the mixed news flow. For example, we saw a record jump in US unemployment and news that the US is poised to overtake China as having the most coronavirus cases. Nevertheless, we were able to take comfort from the signing of the US fiscal stimulus package coupled with the central bank comments and actions. The Fed chair, Jay Powell, reassured us that the US central bank is not going to run out of ammunition to fight this economic downturn, while the European Central Bank, ECB, boosted its firepower by scrapping its bond buying limits for the Pandemic Emergency Purchase Programme. However, while all the global monetary and fiscal policy stimulus is both correct and necessary given the speed and magnitude of the economic damage from the coronavirus outbreak, having experienced a number of crises, including the 1987 crash, the 1997 Asian financial crisis, the dot-com boom, bubble, 9/11 terrorist attacks, and the global financial crises in 2008-2009, unfortunately, it is safe to say that the volatility will remain the norm until we see a slowing of the spread of the coronavirus outbreak and lockdowns are lifted, as equity markets hate uncertainty and the coronavirus outbreak is a big uncertainty. While we appreciate that this volatility is unnerving, it is important to maintain a long-term perspective, as we often see and hear investors wanting to sell their investments after equity markets have fallen. People have an interesting characteristic in that generally the cheaper an investment gets, the less people want to invest. That characteristic is not reflected elsewhere. For example, with consumer purchases, as we all enjoy shopping for bargains in the sales on the high street. In the meantime, we want you to know that we're doing everything we can to ensure you are kept fully up to date. And with that in mind, we've been reasonably active with your portfolios this week. We've repurchased many of the Barclays shares at 103.3p that we sold earlier in the month at 118.6p due to the strength and visibility of its capital position. We've also increased clients' weightings in the miners, BHP and Glencore, as they've both fallen heavily due to weaker global economic outlook. But with China starting to recover, the risk-reward now looks quite compelling. However, following the strong rise in US equities, we slightly reduced our US exposure by reducing the holding in JP Morgan US Equity Fund. As a result, while we remain positive on equities over the long term, particularly those in Asia and emerging markets, we have maintained our short-term cautious stance with a slightly higher than normal level of cash, including in liquidity funds, around 10% in the cautious, balanced and adventurous risk-based portfolios. And when we see opportunities arise, we will start to reduce this cash balance by adding to your investments with some of those bargains. Now, please remember that whilst we're working from home, we are still here and available for you if you want to talk about markets, if you want to talk about tax year end or any other aspect of your financial planning. Call us, email us, we're here to help. in the normal way.